Today I'm going to cover inflation, the Fed, and the direction of the stock market. I'm going to feature the video from Felix Zulauf and then one from Neel Kashkari, the Minneapolis Fed, and former Treasury Secretary Larry Summers. Hi, I'm Ben Reppond. Welcome to my YouTube video. Today is Valentine's Day, February 14, 2023. Let's begin with a video clip from Felix Zulauf. Last week I played one. It was about a minute and a half long, and he focused on what he believed to be the direction of the stock market for 2023 and 2024. One of the things that he said in there was that there is likely to be, he predicted that the market is probably going to go down during the first half of 2023. And then from there, it would rise in the second half and into 2024. And he gave some specifics around that. One of the things that he mentioned was there's likely to be a credit event that will send the market down during the first half of 2023. Now, I thought that was interesting, and I want to unpack that a little more. I had some people that wanted to hear more about that, so I'm going to play that. And I think what he's done, he kind of inferred this, that he's looked at previous bear markets and he has found that there toward the end of that bear market is usually a credit event. What does that mean? What I think it means, what he's saying is there is likely to be a bankruptcy or a series of bankruptcies that are of a serious nature. Could be countries that default on their debt. It could be corporations, or it could be one that triggers another and another. Something like that is going to likely send equity prices down. Once that occurs, the market hits a intermediate term bottom, then it is ready. The air, at least for the time being, is sufficiently out of the balloon and the market is ready to take off. So he's going to unpack this and give some detail around that credit event. So I thought I would play this for you. Take a listen.
Usually we see something breaking at the end of a cyclical down market, the bear market, and usually it's somewhere in the region or associated with an industry that experienced huge excesses before. And I think China is where the biggest credit excesses have been, and where there is some real estate deflation going on, which creates deflationary problems and could lead to some shocking events. I cannot predict what and where the credit event will be, but I think it's normal to expect something along those lines late in the down cycle, because the tightening of money means that there is too expensive money or not enough money available for some of the weak guys out there.
Yep.
And then they get hit. And when that hits, that is the signal for the Fed, the message for the Fed and other central banks. Now we have gone too far. Now we have to correct, because if this goes further, then more of those entities could fall into problems, and then we have a much bigger problem on our desk. Let's look at China just in an isolated way. If the Chinese authorities would do what most of the exports are expecting and tell them to do, namely stimulate like mad, they would trigger off a slump in the Chinese currency. And the slump of the Chinese currency would trigger off an Asian crisis probably bigger than in 1997. This would be detrimental to the long-term goals of China in terms of trade and politics, and therefore they are not going to do that. Therefore, they are trying to sit it out, help here and there, etc. Now, if we have a credit event in China, we have to keep in mind that there are a few trillions of bank loans, US dollar denominated, to Chinese entities. And I mean, in early 21, China, the government ask those corporations, those debtors, to pay back at least 1/4 of the outstanding dollar-denominated loans, because they do not want to be in the position of getting blackmailed by the US when they are entering a conflict situation with them. So they have paid back some of them, but I assume that there are still at least $3 trillion dollars out there in bank loans, and those are short-term loans, not long-term loans. And if an entity cannot pay back, it hits back to the US banking system. And maybe in between the US banks, there are European banks or Japanese banks or Singapore banks. So it rattles the whole international banking industry. And in that sense, we are all connected.
As I said, what seems to be the trigger here is this credit event, and occurring sometime perhaps in the first half of 2023. These are just predictions. The reason I think this is significant from Felix Zulauf is that he has such high credibility because of his decades of experience, but his incredible insight and his track record of being right on his predictions most of the time. So because of that, I give a lot of weight to this. And again, no one knows for sure. None of us have a crystal ball, including Felix Zulauf. But I thought it was an interesting comment. Now I want to play a piece from Bloomberg's David Weston is interviewing former Treasury Secretary Larry Summers. And Larry Summers goes into some detail about what he thinks is happening with the Fed, interest rate hikes, and inflation. Interesting perspective, and again, he gives some detail to it. Take a listen.
So, Larry, one of the big events of this week was Jay Powell, the chair of the Federal Reserve, speaking with our very own David Rubenstein at the Economic Club in Washington. And the markets came away from that saying, you know what, he didn't go as far as we thought he would. It's saying we've got to tighten more given those jobs numbers. Are we becoming complacent? Because there's talk on Wall Street now that there won't be any landing, whether it's soft or hard. Basically, we'll just keep going.
I think the Fed understands that it doesn't understand, because no one can know the future with confidence. And I think that the Fed is determined to do what's necessary. That's certainly what I hope is the case in a substantially uncertain environment. I think the consensus has become substantially too complacent about inflation for a variety of reasons. First, let's be clear. Even after the reductions we have seen, inflation today is at levels that would have been unimaginable for inflation 2 years ago. And so we haven't come all the way down or got this fully under control. And in a way, I guess one way to put it in Super Bowl week here is that it's easier to move the ball down the field at midfield than it is when you're in the red zone. And we're getting closer to the red zone with respect to inflation. And so I think the gains in terms of further reduction are going to come harder. Second, I think there are a variety of bounce back factors that we're going to have. You saw it in the market wholesale used car prices, which look like they're going to be a positive contributor to inflation. You've seen some reversal on gasoline prices. More broadly, you've seen a variety of prices that blipped way up 9 months or so ago, and now that's mean reverting. Now that's coming back to normal. Well, it's not always going to be going down, and when those become normal, that's going to be an increment to the underlying inflation figure. And so that, too, I think, is a cause for concern. Third, if you look at the variables that economists tend to think that you should look at to predict what's happening with inflation, we are an economy that's got relatively loose financial conditions now, given what's happened to markets. By some measures, financial conditions are looser than they were when all this tightening started. That's probably misleading, but we probably are back to somewhere where we were late last summer in terms of the degree of tightness in financial markets. And we've got that at a time when we still have a record level of vacancies relative to unemployment. So I think with that kind of picture, the prospect that we are not on a trajectory now where inflation is going to get to the target level, and therefore this tightening cycle is not just about one more, two more, three more 25 basis point increases, but something more fundamental. That's a substantial probability in this environment. So I don't think it's a moment for any kind of euphoria. And I think there is some complacency that's setting in many places.
As you heard right at the end with Larry Summers, he said, and the market is always trying to get ahead of itself. He says, be careful. Don't be too optimistic. Don't be too energetic about the market quite yet. And I thought that was good counsel. Now I'm going to play a video from Deidre Bosa from CNBC, and she's interviewing Annandale Capital's George Seay. George Seay points out that, just like we heard from Felix Zulauf, that there's probably more downside ahead on equities, and that, then a rise following that. Again, echoing what a lot of people have said. And he goes on to say, you'll pick up on this, that this is an environment that is probably going to play well with active investment management. The reason that caught my attention was because that's the style of investing that we do. We do active management. And what that implies is that the traditional buy and hold investing method is probably going to frustrate a lot of investors.
Our next guest says, don't trust the tech bounce. We've seen these last few weeks. Joining us now, Annandale Capital founder and chairman George Seay. George, good morning to you. I'm sure you just heard that discussion with Steve Leisman. If Fed Chair Powell doesn't have to do much fixin', as Leisman put it, and the rally has continued at the same time the bond yields have moved up, what could ruin this rally here?
Hi, Deirdre. Well, there's so many things that could ruin the rally. The animal spirits are back. The art complex is moving up fast and furious, and everybody wants to go up and to the right. And what we hope is going to happen and what actually happens rarely align themselves. And does Chairman Powell really have to stop at a 5 to 5.25 range, or could he go higher than that? Well, the market is predicting he's going to stop there or even earlier than that. And he certainly doesn't have to if he doesn't like it, jobs numbers and inflation creeping back. So I think that people who are putting on their animal spirits hats again may be a little premature and might want to take some risk off or hedge their bets a little bit.
Okay, George, how do you judge the quality of this rally then? I know a lot has been made about some of the low quality, unprofitable names have seen a surge, but we also saw the mega cap tech companies post results that, yes, they weren't all that great, but it seems to be baked in because they've also regained their leadership this year.
This market reminds me a lot more, Deidre, of 2000 to 2002 than 2007 to 2009. I don't think the valuations were as extreme now as they were back then. In fact, I think quantitatively you can make that as a certainty. But I do think we had a lot of false starts in that 2.5-year period before we finally left that bear market behind. And I think this is probably a false start. I think it's going to take us more churning and more working out where multiples settle down towards more where earnings growth is, and earnings growth is slowing, and I think the multiples have still got some workout to do left. So going right back off to the races, I question that. I just don't think that's going to hold.
Yeah, George, that's curious. I mean, people have talked about the fear about earnings revisions being pretty tough, but there have been some high-profile cases at Spotify and Netflix and Meta where revisions went the other way. Do you think that eventually does turn back, though, to the downside?
I think it depends on the company, Carl. You got to go company basis on a one-to-one analysis, and there's such a mixed batch of earnings we've been seeing. Some companies have surprised the upside. The Meta reaction was euphoric. It was really powerful, and I'm glad I'm a stockholder. but I'm also a stockholder of Amazon, and it got absolutely drilled last week. And I hope it gets drilled a lot more, so I can buy a lot more, a lot lower. But it's very company specific, and that's not a super healthy market. You want to see breadth. And right now, we're seeing a lot of speculative tech breadth, and among the blue chips, as Deirdre said as well. But I just don't think it's sustainable. I think we're going to have a lot of starting and stopping and a lot of chop. And I think a lot of young investors who didn't go through the Great Recession or the tech bubble bursting are not used to a market that doesn't just go up and to the right like we've seen for over a decade. And this is going to be a different period of time, I think. And I think active investors have got a leg up for the first time in a long time.
You heard on the clip from Larry Summers that what his view of inflation is. Now I'm going to play another piece from the Minneapolis Fed President, Neel Kashkari, and you'll get his view on inflation and what the Fed is doing to fight it. Again, I thought it was very insightful, and what was interesting was that, what is interesting you'll listen to, is that he admits very honestly, said, we got it wrong. We called it wrong. We looked at the data. We said this inflation is transitory. It wasn't transitory. I don't think he said it, but it's something implied. We probably couldn't have gotten any more wrong. And that, to me, gives a lot of credibility. I think it would be helpful if Chairman Powell would say things like that, because, he's, I think his credibility has been diminished. But anyway, here's a piece from Minneapolis Fed President Neel Kashkari. Take a listen.
Where does 5.4 come from? Yeah. We're, by the way, in a range now of 4.5 to 4.75.
Correct. So once every 3 months, each FOMC, Federal Open Market Committee participant, needs to submit essentially a forecast of what we think optimal monetary policy will be and how the economy will respond. And it's a tough thing. Once every 3 months, we have to write something down. And we have a lot, I'm sure Susan does this with her colleagues, a lot of deliberation with my economists at the Minneapolis Fed on what do we think the underlying trends are for inflation, how responsive do we think the economy is going to be to our rate hikes, how long does monetary policy take to work its way through the economy. So there's a lot of judgment and art in addition to attempts at science to try to put down something. And basically, last year, I concluded, and I think many of my colleagues concluded, that the traditional economic models that we rely on to understand inflationary dynamics have really failed in the reopening of the economy. We did not see, just to be blunt, we did not see the giant inflation coming, and we did not expect it to last as long as it did. As you might recall, many of us said we thought it would be transitory. Well, what we ended up having does not feel like transitory. So once I concluded that, hey, these models are not working, then how do we still have to make decisions. How do you make decisions if your fundamental tool is not working? Well, we have to let the inflation guide us. And it's raising rates aggressively to try to get real interest rates positive. It's unlikely that negative real interest rates would be restraining the economy. So we need to get real positive interest rates across the yield curve, get there as fast as we can, and then watch inflation and see how inflation responds. And so far, headline inflation has come down because oil and food prices in many cases have come down. Core inflation has come down because goods prices have fallen. But the services side of the economy is still hot. And we know housing inflation is a big part of that, but we can actually analyze and forecast housing pretty well. If you look at new leases that get signed, it takes a year or two for them to work their way through the official inflation statistics. So if you strip out housing, you're left with this part of the economy called core services X housing. Think about the services economy, the wages that people are paying and people are earning. We haven't seen any movement there. And so there's some hopeful signs, but there's not yet much evidence in my judgment that the rate hikes that we've done so far are having much effect on the labor market. And we need to bring the labor market into balance. So that tells me we need to do more. How much more? I don't know for sure.
Okay, next I want to talk about the Fed and the Fed's balance sheet. Now, I apologize for this being such fine print and kind of so squished down. It goes over a long period of time. This is just the way they report it. But just in general track, you can see there is a line that makes its way up. What that is the assets on the Federal Reserve balance sheet. That rise came about from buying securities. They were buying treasury notes and mortgage-backed securities over that period of time in order to pump liquidity into the market. They also lowered interest rates, or kept interest rates low. Then what happened is in this past year is that they have been raising interest rates, which is trying to put the brakes on a hot economy. And they're also selling assets, the same assets, mortgage-backed securities and treasuries. They said last year in 2022 that they were going to start in June selling $47.5 billion per year for 3 months of those assets. And then in September, they were going to double that to $95 billion. To the best of my knowledge, they have been doing that, selling $95 billion per month off of their balance sheet. What that's doing is sucking liquidity out of the market, $95 billion a month out of the economy. And so and there is a saying, Stanley Druckenmiller says it, and I think Ray Dalio says it, is that liquidity drives markets, not volume, not price earnings, not other traditional metrics, but liquidity drives markets. What is happening here is liquidity is being pulled out of the market at the rate of $95 billion a month. What was pushing the market up was injecting liquidity into the market. And that worked. It worked following 2008. And the market went generally the direction that you see this line is going. But now it's going the other way. I don't believe they've got a time frame to end that selling of treasuries and mortgage-backed securities. I think it's going to continue indefinitely. Now, maybe they hit a point where they, stop, or they even start buying again. That could easily happen. But until that happens, you can see at the very end, the balance sheet is going from about $9 trillion of mortgage-backed securities and treasuries, and is starting to decline. That's a result of these sales that are happening right now. So I think that is not a good thing, but again, they back themselves into a corner, and they've got to clean up this balance sheet. So it's we'll see how it plays out, but I think this is negative for the market and negative for the economy. A year or so ago, a couple of years ago, I think it was 2020, I played some videos around what was going on with shipping containers coming from the Far East, and everywhere, but especially the Far East. And what was happening is the price of shipping a container on a cargo ship went sky high, and that's reflected in this chart that went sky high. What's happened since that time, so this would be sometime in late 2021, is that the cost of shipping has come down dramatically. And now it is about $2,000 a container, coming down from around $10,000 a container. That's a factor of 5. That's a lot. And so I think it's supply and demand. I think there are not as many goods that are being consumed here, and not as many goods being shipped there. So it's just dropping. It looks like it's going to continue to drop. Less container traffic, less freight, and lower prices. Housing has been affected significantly from interest rates. This is a chart that shows that this is a house price index put out by Freddie Mac, and you can see the degree of the drop. Prices are still increasing nationally, but at a much slower rate. Some areas they've actually certainly declined. This chart shows the number of resale home purchase contracts that have received multiple offers last month. So you can see that the multiple offers have come from here down to here. There are still homes that are getting multiple offers, but there would have to be justification for it, and it is not happening as a matter of course nationally. Okay, this is a chart showing consumer credit. This is probably a lot of credit card debt, but you can see what happened during 2020. There was a drop, and then there's an increase in use of credit cards to the point at the very end where it is going over the trend line. So right now there is, and again, I think this is a function of inflation. Inflation has put a squeeze on a lot of people, and they have only so much income, and relying on credit card debt is a necessity for some people. And so, but that, of course, long term is not a good picture. But anyway, I just thought that was an interesting chart. Okay, I'm going to give you the flow of funds report from last week. It's reported from even the week before that, so there's a little bit of a delay in it. And you can see that conventional equity funds had outflows again of $12 billion. Conventional bond funds, however, had inflows of almost $10 billion, and money market funds had outflows of $16 billion. If you went to the Super Bowl and you looked around for me, I wasn't there, by the way. If you want to know why I wasn't there, maybe this chart tells you why I wasn't there. And by the way, don't look for me next year. I won't be there either. Average ticket price, $5,700. So if there's two of you going to the Super Bowl, that's over $11,000 for just the two of you, plus travel and housing and so forth. If you got to the club level, by the way, I wasn't at the club level either, $10,000 to $30,000 per seat. Interesting, isn't it? Well, happy Valentine's Day. Today is February 14th. And the bears in the stock market are maybe wishing the bulls happy Valentine's Day. But be careful. They've got a loaded gun somewhere stashed behind them. So I thought that was interesting. Anyway, happy Valentine's Day. If you have questions or comments, feel free to leave them in the comment section below, and I will answer them. Thanks.